All right, today we're diving into a really fascinating corporate drama. A tale of two completely different stories. You know, one of those moments where a company thinks it has amazing news, but the market hears something else entirely. We're talking about packaging giant Amcor, and a day they'd probably love to forget.
I mean, it's got to be every CEO's worst nightmare, right? You spend months preparing. You have this huge game-changing story to tell. You lay it all out for investors, and they just hate it. That is exactly what happened to Amcor. So let's unpack what went so wrong.
So what did that rejection look like? Well, it looked like this number, a brutal 13.5% drop in one day. Think about that for a second. After laying out what they thought was a brilliant vision, the stock didn't just slip, it cratered. A total hangover. To really get what happened, we got to look at the lead up. And you got to understand, this wasn't just some run-of-the-mill quarterly update. No way. Just a few months before this, Amcor had closed this absolutely massive deal to buy Berry Global. So this was the big reveal. The first time anyone really got to peek under the hood of this new mega company. The stakes were, well, they were about as high as they get.
Okay, so this is where we get into this tale of two stories. Let's start with the first one, the story Amcor's management wanted to tell. This was the sunshine and rainbows version, their big optimistic pitch for the future. And they came out swinging. I mean, listen to this, straight from the CEO. You can just hear the confidence, right? We're talking 12 to 17% EPS growth, and free cash flow not just growing, but doubling. This is exactly the kind of stuff that investors usually eat up. And it was all built around one really important idea: synergy. Yeah, I know, it's a total corporate buzzword, but here, it's the whole ballgame. The idea is simple, right? It's that 1 + 1 = 3. Amcor was basically saying, hey, by putting our two companies together, we're going to create something way more powerful and profitable than either of us were on our own. And they didn't just talk in abstracts. They put a huge, concrete number on it: $650 million. That's how much they promised in total savings by fiscal 28. So we're not talking about some minor efficiency gain here. This was a central pillar of their entire pitch. And to make it even more believable, they broke it down for the short term too. They said, look, for fiscal 26 alone, we're targeting $260 million. And the best part? The lion's share of that, $240 million, was coming from real, tangible stuff. You know, cost-cutting actions investors can actually track. So the picture they're painting is of an absolute cash machine. I mean, doubling free cash flow to almost $1.9 billion? That's the kind of thing that makes investors' ears perk up. That's the money you use to pay down debt, buy back your own stock. It's the good stuff. It really was a fantastic story. So you have to ask, where did it all go off the rails? And that brings us to the other side of the coin. The second story, the one the market actually heard. Because while management was gazing into the future, 2026 and beyond, investors were looking right at their feet, and they did not like what they saw. And it really all started with this: a tiny 1-cent miss on their earnings per share. And I know what you're thinking, it's a penny, who cares? Well, Wall Street cares a lot, especially right after a gigantic merger. A miss, even a small one, is like a crack in the foundation. It makes everyone wonder what else is wrong, and it got them digging.
And what they found wasn't pretty. Turns out, sales volumes were actually down. The weakness was really focused in North America. And there was one division that was a real problem child, the North American beverage unit. I mean, it was a mess. They were having major operational headaches, leading to higher costs for everything: freight, labor, and they just weren't getting the job done for their customers. It was like one bad apple spoiling the whole bunch.
So this slide right here, this is the whole story in a nutshell. It's the great disconnect. You have management talking about the amazing future, synergies, cash flow, the long-term vision. But the market? The market was totally fixated on the here and now, the Q4 miss, the weak volumes, and that problem child in North America. The beautiful story about tomorrow got completely drowned out by the ugly truth of today. Okay, so your stock is in a nosedive. Investor confidence is shot. What do? Well, you have to pivot fast. Management had to switch gears from being visionaries to being plumbers. They had to show they could fix the leaks, and they came out with a very specific plan. And job number one was dealing with that problem child. They laid out a simple 4-step playbook. Step 1, isolate it. Put it in its own little box so you can focus on it. Step 2, restaff. Get new leadership in there. Step 3, stabilize. Just stop the bleeding and fix the basic operational issues. And then, and only then, step 4, evaluate. figure out what to do with it long term, which is basically code for get it ready to sell.
And this quote right here says it all. It's management being brutally honest. They're basically saying, look, we can't sell this thing while it's a disaster. They know they have to roll up their sleeves and fix it first before anyone would even consider buying it. It's super pragmatic.
And this wasn't just about that one beverage unit. Oh no, they revealed they were putting a whole portfolio of businesses under review. Businesses that did $2.5 billion in sales. So this shifted from a small repair job to a massive strategic rethink of the whole company.
So, what's the plan for all the cash they'd get from selling this stuff? One goal and one goal only, deleveraging. It's a fancy word for paying down debt. Remember, they took on a ton of debt to buy Berry Global, so their absolute top priority was to use this cash to get their balance sheet back in shape.
And here's the roadmap. They showed everyone, okay, right now our debt is at 3.5 times our earnings. The goal for the next 12 months, get that down to around 3.1 or 3.2. And longer term, they want to be back in their comfort zone. It's a clear, transparent plan to get financially healthy again, which is exactly what investors needed to hear.
So let's zoom out. After all that drama, what's the real lesson here? What can we all learn from Amcor's absolutely terrible day on the market?
You know, this whole episode is really a perfect case study. It teaches us a few huge lessons. First, you can have the best long-term story in the world, but if you mess up the here and now, nobody's going to care. Second, integrating a huge acquisition is always harder than it looks. Third, Wall Street hates surprises, period. One problem area can poison the whole narrative. And finally, in a shaky economy, investors cling to what a company can control itself. Things like cost-cutting, not just hopes and dreams.
So that leads us to the big question looking ahead.
Because at the end of the day, the ultimate question for Amcor is actually pretty simple. After a day like that, telling a great story just isn't going to cut it anymore. The market's message was loud and clear. Stop talking, start doing. Show us the results. They've got the plan, a very ambitious one, but can they execute on it fast enough to win back that trust they lost? That's the billion-dollar question. Thanks for joining The Explainer.